So I always rave about how much I love teachers and coaches because it's such an honorable profession. One of the other professions I think moving forward that's important is financial planners. Now I got my man Paul Barbieri in Virginia and my man Bruce Blake in Maryland, but I didn't have anybody in Pennsylvania when I moved here, and I found Paul Nichols of Financial Abundance, and you talk about a sharp dude. I had to have him in my real estate ride this week, and we're going to talk about something everyone's talking about, and that's the new tax plan. So let's hear what Paul has to say and see him drop some knowledge. My man,
Brian,
what's up? How you doing, sir?
yeah, that's good.
Good to see you. Good to see you. So it took me about I think a year for us to connect. And what was interesting is that not that there's anything wrong with what I'll call the big box financial planners, but you wanted to be independently licensed. Tell me about that transition.
Yeah, I didn't like some of the products that we were forced to offer clients, so we had to go direct with the Securities and Exchange Commission in order to get out from under that umbrella and still do business.
Right, and it obviously allowed you a little bit more flexibility.
Yeah, because we have the whole, investment,
Spectrum.
Yeah, right, the whole spectrum. Plethora.
And one of the unique things, maybe unique isn't even the right word, but you are more of a tax-based financial planner. Talk about that a little bit.
Well, we focus on, investing assets and manage them, but a lot of our clients have tax problems. You're either going to have an income problem or a tax problem. You can't have both in the final analysis. If you don't have enough income as time goes by, then you obviously don't have a tax problem.
Right.
But if most people that we would work with, or I should say the majority of them, would have more issues in the tax arena because of incomes and so on and so forth, which is why the new tax plan is so good for middle class America.
Yeah, that's exactly what I wanted to get into is the new tax plan. Who does it positively affect, negatively affect? What do you see it, the average homeowner, how's it affecting them?
We see there's no question the vast majority of people are going to benefit from it. And you got to think about it this way. Most people don't understand the difference between marginal and effective tax rates.
Okay.
Marginal is the bracket you end up in.
Right.
But effectively, it would be the means weighted or average of the brackets you went through to get to that bracket. So what's happened with the new tax plan is we have a situation where almost all the brackets have been reduced by 3%. So everyone's going to save at least 3% on their tax bill. But the most important thing, and I think this is hugely under-promoted and overlooked, is the standard deductions. See, normally if you had, let's say that you had some deductions like a mortgage deduction or a home equity line of credit deduction, or maybe a medical deduction, or maybe what else would be another, your IRA, your 401k, stuff like that.
Right.
What ends up happening is if you have greater than $13,000 in deductions, charity and different things like that, before the tax plan, well then you would itemize.
Right.
Well, if you didn't have more than the standard deduction, which is now $24,000 for a couple, $13,000 for a single, then you're not going to need to itemize anymore, because very few people, unless you're a higher income earner or a sole proprietor or a business owner, you're generally not going to be there. So what I see is a huge swath of people that won't even need to do anything but a basic tax.
Right, make it easier for them.
Make it a lot easier. Plus, if you're in the 22% bracket where most of the people are, 22, 20, 28, the new 24, 28 in the new brackets, what ends up happening is you got to realize if you're in the 25% bracket before and they give you $24,000, what people need to understand is that's 24 grand right off the top of your income. So if a couple in state college, we have a lot of professional couples here, right? Okay, and dual income earners. So if you had a couple making, 75, 100 grand, if they're making $100,000 collectively, 25 off the top is 75, they're going to drop into a bracket lower than the bracket they were in before.
Right. So it sounds like, really, unless you are in one of the coastal states like a California, New Jersey, New York, with the high values and the high tax bracket, you're benefited from this new tax.
Well, even in those, the coastal states, Jersey and California, we have clients there. What you end up with, the higher income earners really didn't get helped by the tax plan. they didn't really get hurt.
Right.
Because what happens is they dropped a couple percentage in bracket. At the same time, they took away some of the deductions, primarily the mortgage deduction that dropped
Right.
from $1 million to $750 for combined homes. So,
Right.
Here in this area, even if someone had a home in Florida and a home in the State College or in Central PA,
It still might not add up to $750.
maybe not, yeah.
Right.
And most people don't really want to hawk it that much unless they're leveraged or understand opportunity growth and some of that. So your average American wouldn't even touch it. So it doesn't affect them. But the higher income earners definitely didn't get helped. And I think that's interesting. It depends on where they fall overall. So across the board, it should promote economic growth because there's more money in people's pockets, or at least we'll have more money to spend.
Well, everybody would be happy to hear that, and that's why, I wanted to hear it from a professional, not talking heads on the television. Now, I don't know how many times I've taken your financial literacy class, but one of the questions you always ask that I love is about the taxes, accessing the taxes in retirement. Do you think taxes are going to be higher, lower, or the same? Let's talk about why you asked that question.
Well, we asked that question because most people never think about the unnecessary and unwanted transfer of some of their wealth to the government. What a lot of people don't think about is when they defer taxes. We know we all defer taxes, trying to save a little bit on the seed money now. But tax rates, even if they stay the same, what we end up with by deferring taxes is we defer the tax calculation. So we really don't know what's going to happen until you start to pull the money out. And what we found is as time goes by, tax rates may have lowered some, but deductions have gone away. So when somebody retires, their house is paid off generally. They're not funding a 401k or an IRA, and their kids are generally gone, and they're in the same tax bracket as when they earned. It's rare that people drop in tax brackets. So now they have this harvest that they have to pay, taxes on. I just had a client yesterday that was really torqued about it, and I said, look, you've been deferring it all these years. It's time to pay the piper now. I mean, nobody likes to pay taxes, but it's one of those situations. So the question most people need to ask is, before you defer taxes today, what is that going to mean to the tax calculation later? And what people need to understand is it's to the government's benefit to defer taxes and end up with much more tax revenue. And really, it's to the advantage of the financial industry's benefit, because what happens is, if you're a financial advisor, you're being paid a fee or a commission, however you work. Would you rather have it on the pre-tax or post-tax amount?
Right.
So you have a lot of advisors that they don't do it intentionally, but they end up, because it makes sense to promote and defer taxes, they end up getting, people end up paying fees on money they ultimately pay to the government.
Right. So it's more about, would you rather pay taxes now? Or, because the answer to the question, most people, when I sit in your class, they raise their hand, they say, well, I'd rather pay taxes now because I think they're going to be higher when I retire.
Well, most people defer them and they don't realize that they're postponing them for a higher. Yeah, so it's like the farmer story where you have if you're a farmer, would you rather pay seed on the tax or seed on the harvest? And the harvest is where most of us pay it with the traditional IRA or 401k or an IRA, which really, when you start to understand money and taxes and the way that works, why it makes sense sometimes to carry a mortgage, to offset some of the tax liability, if you understand that you don't want to defer taxes.
Right, and so to reiterate, it makes sense to pay the taxes on the seed, not the harvest.
For most people.
Exactly.
Yeah.
And you bring up another good point, and I have this conversation with my clients, is I'll ask them, do you see your house as a place to rest your head, or do you see your house as an investment? If it's a place to rest your head, then by all means, pay it off. You can sleep well at night knowing it's paid off. But if you see it as an investment, it may not be the best investment. And tell us why that is.
Well, you got to realize what happens to most people when we look at total financial planning. We deal with a lot of retirement planning. Is most people will accrue in their retirement savings about the value of their home. It's interesting how often that happens. What they don't realize is for many, many years, because there's no return on equity, there's no return on the money in their home, people mistakenly think that, well, my home is worth more now than it was 20 years ago. Well, It's not worth more now because your house appreciated. It's worth more now because dollars depreciated.
Right.
It takes more dollars to buy the same amount. So, if you have your home paid off, that's the safest position you can be in with your home.
Right.
Okay. Well, the second safest position you can be in would be hocked to the gills, have the money separate, have the ability to pay it off anytime you want, but to be earning money on the money you have outside in a liquid, safe environment. I got to stress liquid, safe environment.
Right, because the 4 tenets of a good, sound financial investment, and this is stuff you've taught me. Number 1, liquidity, return on investment, security of principal that you initially invested, and tax advantage.
If you can get the tax favored, yeah, absolutely.
Right.
So most people, the two biggest mistakes most Americans make, you've hit on them really, is should you defer taxes? Most people don't realize they pay 10 to 12 times back the tax bill that they save. And should you really look at your home as an investment? Has anyone ever asked you what the yield is on your home? But yet you would hold my feet to the fire on anything I would suggest, right?
Right.
From a yield, safety, and
right.
What's interesting about homes is people put all the money in them and they won't think about getting any money out for 25, 30 years.
Right, so it's just sitting there idly, not earning.
But any other investment, they want to know if they can get it tomorrow.
Right, yeah. And that's, I think, a really important part is like it's not our grandparents' mortgage anymore where they worked for the same company for 30 years. They had a nice parachute when they retired of money and a watch. Now people are changing jobs. Big companies aren't doing the same kinds of benefits.
Well, who got hurt the most in 2008? People that had a bunch of equity in their home lost their job.
Right.
They had all that. They're paying extra payments, trying to get it paid off, lost their job, and ended up losing the house and all the extra money in it.
Right, because they don't care that you had paid it. You'd been paying it down or accelerating the payment.
That's their problem. That's not what they're in business for.
And then to kind of jump on what you said about hock to the gills or totally paid off. In a foreclosure, which one is going to be the most likely? The one that's
the bank's going to be made a lot more whole than you. You know what I mean? But what happens is, what a lot of people don't realize is the last houses getting foreclosed on are the ones that have the most debt on them. Because it's not to the bank's advantage to foreclose on the house. It's only to the bank's advantage to foreclose on the house if there's enough equity in there that the house still has value and there's enough play in a spread.
Right.
So if the house is worth 60 and it was worth 100 and they've got 40,000 in equity, well, they'll probably foreclose on that first because they got 20 grand to work with in between.
Right. And to accentuate what you're saying, because oftentimes when you have that discussion in your class, someone will say, well, when do I pay off the house? And then your answer is,
well, you can pay it off anytime you want by pinning a check. The question is, when would you want to pin the check?
Right.
And now the question that most people don't realize, because we do retirement planning and estate planning, and we've been through a number of states where we've lost clients. We have several hundred clients now. What ends up happening is the first thing the heirs do is grab a for sale sign.
Right.
So a lot of people think, well, I'm saving this house for my heirs. Well, it becomes more of a burden than a blessing.
Yeah.
It'd be better if they could just say, have options. I can take the money, I can take the house, I can sell the house, I can do whatever. But when do you not need the tax advantage?
Right. And so you're essentially, for a lot of your clients that meet that criteria, you've created, instead of one asset, which is the house, you've created two: a house and an asset that meets all the tenets of a sound financial advice investment that could actually, you could write a check to pay off that house.
Right. A lot of people, what you'll see is very common. Someone will retire, they'll take their 401k and pay off the house. So they took the cash they had and just tied it up in a house that they can't get the cash out of anymore.
Right.
Now they plan on, their logic is I want to pay a lower no mortgage. So I save myself a line item in my budget. What they don't realize is the money they took to save the line item is cost them twice the line item.
Right.
In opportunity cost, So it's a matter of getting people to understand the way things work today, and it's actually oftentimes financial rule of thumbs sound good until you dig a layer or two a little deeper. Mm-hmm. And for people that are good stewards, and that would be, it doesn't matter what income level you're at, because everybody's broke at a different level.
Right.
I mean, that's just a fact, okay? Right. Doesn't matter where you are. If you practice some stewardship, some of these things could make a huge difference.
Right.
How you buy your homes, how you fund your 401ks and IRAs. But the tax plan as a whole, I see it being something that's going to promote and encourage more opportunities for people to invest. Now, here's the reality. If people would take that tax difference and not buy a new TV or
Consume
a
it.
hot tub, or consume it, and actually put it in a Roth account, which is going to be the best thing going moving forward. See, in 10 years, the tax rates are going to go back up, or they have the ability to go back up.
Right.
So they may go back up at least 3%. So most people, there's no question, tax rates are lower now,
Right.
than they're going to be in 10 years because of the way the tax plan was written. So if there's any point you would want to fund a Roth, it's now. Now, what's good about a Roth is you're paying tax on the seed, and it's a tax-free harvest. You're not paying fees on taxes you pay ultimately.
Right.
It's accessible, and what a lot of people don't realize is, did you know that you can access the Roth basis, the contributions, without a penalty?
Right. So it's essentially accruing as if you hadn't pulled it out, or you're not.
Well,
it's not a tax incident.
Yeah. So you're not getting hammered. You already paid taxes on it. So people will say, well, I don't want to put money in there because I might need to get it out. Well, it'd be better putting it in a Roth than a traditional IRA.
Right.
It's better for you. It's not necessarily better for the government. It's not necessarily better for the financial industry. It's less money that they have their hands on, but overall, it's
For the individual.
better. Absolutely.
Right. So the plan is invest it after tax, let it grow tax-free, access it tax-free, and pass on to your heirs tax-free.
That's the plan. If you don't use it, which I'd encourage you to spend it all and not leave them much.
Well, yeah, my father always says, you better hope I go in a fiery plane crash, because if it's slow, I'm spending it all. So I got that. I've been trained on that one. So I talked about your financial literacy classes. When do you teach those, and how could someone sign up for that?
We got one tonight. We're teaching them spring and fall. So they're we do them at Penn State in Altoona. We do them in South Hills here in State College, and we're doing them in Lewisburg. But we do them every spring and fall. And there's brochures that come out. You can check out our website, faicoach.com.
Yeah, I as an added value for my clients, I take them to your classes, and they do love them.
And you get it, Brian. A lot of people, especially you get in ancillary businesses from finance and banking and mortgage and accounting, for that matter. God bless them. They just don't quite understand the whole picture. You get the bigger picture. They understand parts of their industry,
right?
But it's about bringing value to your clients, not just about
a transaction.
Right.
Yeah.
And now you can get the transaction. It's going to happen anyway.
Yeah.
But it'd be nice to know that the client, you're doing the best thing you can for them. So some of this kind of stuff, this coaching, is going to help them, even if they don't utilize it.
Right.
Have a little more peace of mind. You know what I mean?
Yeah.
That's
all right. So what I'll do is I'll put your contact information, because if they miss the class, maybe they could love to spend an hour with you, just seeing where they're sitting with their finances.
Awesome.
Well, I appreciate the time, sir.
Always good to see you, man.
Always a pleasure. You take care.
See you later.